Welcome, everybody, to our sort of founder's guide to capital, talent, and compensation. I am J.Thelander, and I'm going to run the show today along with my esteemed colleagues. We would love for this to be interactive. We have, a lot of expertise in addition to data and analysis, which we can, jump around and hit the topics that are important to you. So please keep the questions coming. Morgan on my team is going to monitor the chat so that we can, make sure that we hit some real time priorities that you have going on as well. So with that, I'm going to turn it over to Alan and Joanna from JM Search, who can introduce themselves and sort of share their angle on what they're seeing in the market today.
Thank you, Jody. Thanks for having us. So Ellen and I co-lead the biopharma practice here at JM. We partner with capital sponsors and individual companies to recruit talent at the executive and board level. And today we'll be tackling the talent perspective and how getting it right on the front end from your cap table is really crucial, and how candidates as well as companies are thinking about things.
And
Great.
I'm
Alan,
Ellen
anything to
Powers.
add on that?
Yeah, well, I had the distinct pleasure of working with Chris Garabedian, the star of our show today, and for him at Zontogeny and the PXV portfolio. Um, so we're looking forward to Chris's insights as well.
Great. Chris, tell us a little bit about, for
Yeah,
those who may not know your illustrious career and
sure.
background, who you are and what you have going on, and
Yeah,
also where you sit today.
yeah, great to be part of this. So I manage two investment strategies or vehicles. One is a venture studio that I founded called Zontogeny, where we really partner with usually first-time CEOs, entrepreneurs, scientific founders that don't have the decades of experience, right? I had come with 35 years of biopharma experience, working mostly on the operations side at AbbVie, Gilead, Celgene with CEO Sarepta before I moved to the investing side. So because the venture studio, where we make seed and pre-seed investments for equity. We're really trying to establish a lean kind of virtual company at the get-go. But then I also manage the venture funds, the Perceptive Ontogeny venture funds for Perceptive Advisors, a multi-stage investment fund, mostly known for their public equity hedge fund. They also have credit funds, Capital Solutions Group, venture. And so on the venture side, it really varies depending on the stage of development, whether it's a Series A or Series B. We've done Series C and Series D. And depending on the stage of the company, the size of the company, we look at compensation through a different lens. And how much capital do we want to support a big team? What's the right time to hire? And we invest across life sciences. So mostly on the drug side, agnostic to therapeutic category. We also do med tech, tools and services, CDMOs, CROs, enabling technologies. So a broad-based perspective from the investment. And I sit on a lot of boards, and so we make a lot of decisions around compensation, hiring as part of our portfolio.
Great. Well, without further ado, I'm going to get into a little bit of data because as you can see here, we have everyone's angle on it. So, Thelander, I'm going to give you sort of our background because it couches the data for our discussion today. So, we are a consulting firm who covers both a private company and investment firm compensation. And we are a global data and consulting firm, and we have been doing this almost 30 years. I've been doing this almost 30 years. And we also have a great podcast and would love for you to check us out. We have founders, CEOs, recruiters. Chris, we're going to have you on. And that has done really well because it's fun. We also, talk about Morgan on my team, who's my daughter. So there's a lot of sort of back and forth that makes it fun too. As far as industry, and I know we have a perspective on this, it's gotten very interesting out there because, we historically only we're only a firm that surveyed life science companies, biotech, medical device, and now tech is, as you can see, over 30% of our data because there's been a lot of cross-fertilization. And we'll get into that about how compensation for both tech as well as life sciences some of the jobs are really competitive across both industries. And then total financing raised to date, I would argue that's the best way to look at data. Chris, do you have a perspective on this? Because we know private companies are staying private longer. They're raising a lot of capital and more than we've ever seen, as you can see with some of these impending IPOs. And so everybody's versus series of financing, they can be two very different things.
Yeah, well, you even are showing almost a U-shaped curve, and I think we see this divide between those larger pools of capital that put in sometimes hundreds of millions of dollars into a Series A fund, and they're designed to build a big team to recruit the best and brightest who have decades of experience. And then on the lower end, you're really looking at more of a capital efficient model where they're trying to remain lean. They're trying to make the post-money values reasonable so they can attract the next round of investors, right? And so there's this tug and pull between how much money do you raise to be able to get to a value inflection and
Yeah.
build the right team versus raising enough to get to the next step, the next step on the ladder, right,
Right.
of value inflection before you bring in
Well,
additional.
here's the post-money valuation. We also survey this, and on our platform, you can customize, you can click a combination of valuation and financing in multiple ways. But just like you're saying that the valuations can fluctuate, and that does impact the cap table, which then impacts the equity awards, but the percentage of fully diluted shares, A, is the most consistent way. And B, if you look by the total amount of financing, then you have a better sense of what that percentage actually means. I mean, Ellen and Joanna, when you're recruiting and candidates are asking you about this, what type of conversation are you getting into around this equity, what it means, the percentage versus a number of shares?
So I actually want to take even a step back for a moment. So what Chris and you have both shared, for the second straight year, we've seen more capital concentrating in fewer, more selective opportunities. And over, let's call it the last year, for all of the companies we've helped support, companies are getting much sharper on the biological hypotheses and disciplined development plans and the assets that can create true pharma relevant inflection points. Now fast forwarding to the actual talent piece, there's nuanced differences companies are thinking about. They're not just hiring executives to build out hundreds and thousands of people. They're hiring leaders who can translate science into value, make disciplined decisions with incomplete data, worked fast, attract more capital, because every time you raise, you're thinking about that next raise, and preserve strategic optionality for partnership acquisitions and next financings. And the only way to really attract that talent is using your cap table. It's not just a financing tool, it is your talent strategy. And that's what we're seeing a lot of right now. Candidates are getting smarter about asking questions on the front end. And that's generally as we get to the negotiation phase. It shows candidates whether a company has truly planned thoughtfully
Right.
or if they're really making it up as they go. So having a solid foundation in place shows and signals to candidates a lot of different things.
Yeah, I mean, here's this is this part also. I mean, I know it's sort of funny because you look at this and almost half the companies have no revenue. So, I mean, it does come up with more of a tech company. And I know that we have predominantly life science companies that are on this. Obviously, your expertise and Chris's as well. But there, again, there is a little bit of a flattening here. Geography also comes into discussion around where companies are located. So our data just it's real time. We pulled this, yesterday for today. Almost we're down. We used to be 95% in the United States. And then within the United States, you can see also we used to be predominantly in the Bay Area, and we know that's no longer true. Chris, do you have an opinion on this?
Yeah, well, I think what we saw with COVID and the lockdowns and all of that, you did see more comfort going to virtual teams and also having a chief medical officer who might be in New York, but head of regulatory being in California. And so we're seeing, especially in the lower end of the financing range, when you're raising hundreds of millions of dollars, that's where you're usually seeing centralized headquarters, whether it be in the Boston, Cambridge, Northeast, or whether it's in the California hubs. But we're seeing more and more companies that might have a technology out of Chicago that has a team that is somewhat scattered. And the idea there is not that they're going to remain that way forever, but until you get to a de-risking, a true value inflection, that's when you have to really start hiring dozens of people, maybe hundreds of people to move it to the rest of the, the goal line of FDA
And I would
approval.
argue that's exactly, and I know Ellen and Joanna, we've had these conversations, but that's exactly the point where you need to put an infrastructure around compensation, looking at your chiefs and VPs and understanding how you're going to pay them and the mix of cash and equity. And then further below that, to be putting in pay plans for your scientists, for your technical people, for your administrative people. I mean, now today, and Ellen and Joanna, I'd love to know your thoughts on this. Look at all these jobs. Look at all these chief
Yeah.
jobs, VP jobs, all these VP jobs, right? Director level jobs. And then we cover, over 300 positions, but so much clinical, regulatory, specialist managers, and managers could be individual contributors, or, they could also be managing teams, engineers galore. And
Yeah.
then with the, all these other roles that are coming up in AI and machine learning, there's a lot of these roles. That's why I'm going to put our plug in now for 2 seconds, because you can't blame me, right? The name on the door is also my
Love it.
last name. And the J.Thelander data does have a lot of street cred. And you can trial the platform for no charge. Morgan just put in the link. It is a give to get model, which has always been our secret sauce. So you give data, and now it used to be that you got a pre-negotiated subset of results back that we ordained, and now you get exactly what you give back. So we know exactly, if you give 5 jobs, you get those 5 jobs. And we want you to be equipped, especially for being a young company, because having a sense of the market is really important. But Joanna and Ellen, when you are dealing with companies and it's a young company, are you seeing that they're asking questions, as someone coming in, around what the rest of the hiring plan is or what's going on?
I'm happy to jump in here. So
Yeah.
definitely as recruiters, we ask that and set the stage up front. We want to know what we're working with. And oftentimes in these early biotech companies, you can't always win with just cash compensation alone. Equity allows founders to truly attract experienced leaders who could command more elsewhere. And so if you want to play ball and bring in talent, this is truly the equity piece is really your tool to do so. And it says to the candidate, like, you have skin in the game to get this done, to get to that inflection point, to actually make it worth money.
And you can see the company headcount. We did this because Carta put an article out, and then PitchBook was trying to, wanted to address it as well, and they came to us. So we looked, because Carta does the cap table management, and that's not what we do. We are really a compensation data and consulting firm. So our data is more specific around the cash and equity mix in addition to headcount. And so we looked at this because life sciences, there's been a slight decrease at the 25 or less employees, but much more stable year over year compared to tech, because they don't hire as much talent to begin with, which is exactly what you were saying, Chris, right? So they start more bifurcated. And I think it's really important, as you're reading all of this and what's going on in the media around companies, tech companies with AI, that it's much leaner. The truth of the matter is the biotech and has been doing this already.
Yeah, and I would say, look, as AI kind of encroaches on hiring plans, we do believe that biotech is one of the least vulnerable. We're all vulnerable to AI, right, in terms of staffing. But because, I'd say the biggest impact that we would see is that the entry level, where you may not expand as much at the entry level period, you're still going to need those domain experts, right, in regulatory, CMC, right, clinical development at the top levels. But we might see, instead of recruiting a bunch of associates or junior managers, you may see that curtailed because of AI.
Yeah, well, here's the data on this, which I really love, that shows you that this is median for an AI ML engineer for life sciences, biotech, device, and diagnostic. That the big equity jump that's happening at private tech companies hasn't hit life science companies in the same way. And we don't know if the yet is really an impending yet, but I think it's very interesting to see that there is more stability. And here's the 75th percentile, for year over year for life sciences, and compared to tech, which is, look at this, a big jump up. So I don't know if this is a lightning rod for what we're seeing. I don't know, Ellen and Joanna, are you seeing this in your search work for tech people?
I'm not seeing it as much. Ellen, what do you think?
No, I don't see it as much.
Yeah. So life
Yeah.
sciences is versus the tech. It's different because tech is really, it's been the crux of their business.
Yeah. Yeah.
Why don't we move into a little bit? I'm going to pull it up here, talking about the option pool because I know that that's really been like sort of the crux. And
Yeah.
maybe Chris, you want to give us a perspective on as you're looking at option pool. You've seen this both from a CEO perspective as well as now being on a board or and also being an investor. How and when does the option pool discussion? Because then it dovetails into the search component and what's relevant, for both executives that are being hired as well as the investors who are investing. And I will couch this for you to maybe just, this is for all data a little bit to talk about the buckets.
Yep. So look, this is very dependent on, you know, uh, how much money is being raised and what the hiring plan is, right? Because obviously the option pool has to support the hiring plan. And so it's kind of two sides of a coin. And when we're talking early, like we have a venture studio model that allows founders to get a lot of direct equity, right? They're having outsized equity positions, right, to start. And so we understand that at that point, right, it's not about incentivizing them further with an option pool. It's really about who else do we need to hire and how do we incentivize folks who are not the founders. The other piece of it is we'll usually wait for either a healthy Series A round or a Series B for sure to talk to investors about what they believe who might be coming in new to a company, what they think is a reasonable amount, because it does affect the dilution. And they do want to make sure that we can hire, the right people, right, for the need of the company at that time. And then the other little lever that we use is we will tell, founding teams that, look, you will experience dilution. I don't think anybody says we're going to make you whole. You're
Yeah.
going to have quote anti-dilution provisions. But what we do say is that hey, we can use the option pool to grant additional equity that's vested over time, particularly for those employees that it's one thing if you're a founder, you take direct equity and then you check out. You're not part of the organization. It's a different thing if you're a founder, you have direct equity, and you're continuing to work every day as CEO or in the C-suite to continue to move that company along. And then that's where we will allow additional grants, particularly related when there's financings that result in dilution for those founders. Will not make them fully whole, but will give them some relief with additional option grants. And then, generally speaking, right, we know the overall statistics are 8% to 15. If you go higher than 15, that may be called into question. If you can keep it low, that is attractive to investors. If you can get by with hiring the right team, and that's why we see more lean teams, virtual teams, fractional C-suite executives until we need to hire those full-time folks. And that's when the option pool becomes more critical.
Well, here's the CEO just to couch this. And I know Joanna and Ellen, you are probably seeing this in effect, right? So this is life sciences and US only because I know we were talking about geography. We're doing a lot of work in the UK right now because there is quite a bit of development coming out of Oxford and Cambridge, and they are looking to have locations both in Cambridge, US versus in Cambridge in UK. And there is a different set of data there. The CEO is very consistent, but the other roles are different. But this is where you can really see the compensation, exactly what Chris was discussing. Here's the dilution. So this is the non-founder equity, and this is the total founder equity. But no matter how you skin this cat, you are going to be diluted. So maybe you can tell us what it's like, Joanna and Ellen, when you are recruiting this non-founder CEO. How are these numbers translating to what you're seeing?
I mean, these are definitely following what we are seeing. I do
This
want
is
to,
median, and here's 75th in case that helps you out too.
yeah, no, I mean, this is what we're seeing. There's always going to be outlier cases, and that's something to really consider here. I actually think, and if you go back to what Chris just said, the infrastructure and really setting up the option pool is really important and having that discussion around that founding team. We are now seeing a movement in the US where universities are spinning out biotech companies, and this is being more and more frequent. And having the early conversation that setting an option pool is not dilution. It's actually really setting up your infrastructure. And without it, every critical hire becomes a negotiation with the board and the cap table. And a well-planned pool gives companies flexibility and also reinforcement that they can make these decisions and not have to have reactive fixes. And that's the thing you want to prevent.
We see this, and you both are raising exactly a good point. So here's our data, and Chris, you really captured it because you gave the sort of the seed stage, and this is what Joanna you're talking about, under
Yeah.
5 million in financing, and could easily be coming out of an academic environment.
Yeah.
And then this is the founders, and the equity, the percentages depend on really how many there are, but the pool is the number to keep your eye on. So you're really between 10 and 15%, and the investors own less. Now, when you get into an earlier stage company, maybe call it Series A, a proper, institutional financing in the 5 to 15 million. And this is, we can cut this multiple ways, but the main thing to see is, as you would expect, the founders have been diluted, the investors own more, but the cap table, the option pool is still around 10 to 15%. And then even as you get more, 15 to 50, 10 to 15%. And here's late stage, 90 million plus, 10 to 15%. So Chris, you obviously know what you're talking about. Yeah. Joanna, you're talking about this. So this companies who are planning for this and don't have to be on the back of their heels, it's really the main thing. And then here are the other pieces that ideally you're thinking about as well, which is, what do you need for the future option plan? What are you going to have to refresh? Because, as Chris said, you're going to have dilution. You're not going to keep everybody whole. But when we looked at our year over year data, there's a significant amount of stability in the market. And then, well, who are you going to be hiring?
Absolutely.
Yeah. And then what type of, well, I want to go back to the stability of the data, because I think it's really important. And I know we have some CMOs and other people on, so we'll look at that data. But this is really, and as you said, Joanna, there are people who are outliers, but this is from the J.Thelander data, where we have the ability to look for our planning by the different financing levels. And you can see that that 5% is almost consistently the number. Chris, are you seeing that for a non-founder CEO of a life science company, 5% equity?
Yeah, I think part of it is, and you mentioned this, Jody, earlier, it's doing the calculation when you engage, and Jim would understand this as well. The executive has gotten more sophisticated of understanding, well, when are you going to raise the next round? How much are you going to raise? Is that 5% equity that I get, is that going to be reduced to 2.5, right? Or is it going to, be holding above 4? Like, that is something that they would want to know. Now, if you're recruiting a CEO and they just raised a $200 million round, that means, wow, that CEO has a lot of runway. They can build a team, they can get to the value inflection. They may be less sensitive to that absolute number being larger. Yeah. So I think it's partly an interaction between what are the financing plans, what's that dilution going to look like, and is it the right number for me to capture the real upside if things are successful?
Well, you can see that it stays pretty stable. This is both at the median as well as the 75th percentile, very stable. And then here is for a tech company to see median 75th and the maximum, but you can see the median 75th higher because tech companies tend to be doing that. And then here is for a life science company who's in the 90 to 150, again, more around that 5-6%, as we were saying. We did have a question that came in, and maybe Joanna and Ellen, Chris, you can answer this. You think our candidates are expecting private market liquidity, some kind of secondary ahead of it, since it's taking so long? I mean, we just saw this, right, that they did secondary for OpenAI, and there was a lot of liquidity. You seeing this with?
Maybe I'll start. Yeah. I don't see too many secondaries in biotech, traditional old school biotech. I think tech, it's more common. You've got bigger portfolios, right? You've got different liquidity needs. I think what we've been waiting for in biotech is the IPO market to open up again, and I think we're starting to see that. So there's less nervousness about, am I ever going to get my money out? Right. And we're seeing a large enough raise where they can get to that value inflection, which is typically the clinical proof of concept data set in patients. Everybody knows if you can get to that point and you have enough money to get to that point, you can be acquired. That's a liquidity event. You have a better chance to go IPO. And maybe you get, larger private equity that might consider a secondary. But traditionally over the decades of the biotech industry, you just don't see as many secondaries on biotech as you see in tech.
Spot on.
Yeah.
Yeah. And you raised another point, which I thought was so interesting, talking about first time, second time CEOs. So are you seeing differences when you're hiring somebody for the first time, or, even if they aren't the founder? I'm going to pull up our data on this, but do you see a difference in compensation and negotiations?
Absolutely.
Yeah.
CEOs who have had repeats, but repeats with success, there's a premium for that, right? You are getting somebody who has examples of success on their track record, and companies will pay for that. Now, how do they pay for it? They'll look at all the different levers. But one thing, going back to what Chris said, somebody who's entering into a company who has a long runway might not be thinking about an anti-dilution clause. Now, somebody who has a shorter runway, that
I
is
don't
an
believe that
asset.
actually sticks. Does an anti-dilution clause actually stick?
Well, it depends on the role, and I would say it depends on how much. I would argue that, we've done a couple of them. We've seen it happen, and they do the math, and I think candidates are actually doing these algorithms to understand how much they're going to be holding after they go out and then raise.
Yeah, where you typically see it, Jody, is that, okay, hey, we're going to do a $5 million seed and we want to hire you now, but you're going to have to raise a $50 million Series A. And then they're like, well, wait a minute, I'm not going to take that dilution. So if you want me to raise that, I need to be protected. And maybe it's through the 50 million, maybe it's through a Series A, maybe it's through the first 30 million raised, but it's usually a cap. It's not an indefinite anti-dilution. I'm
Sure.
going to own 10% of this company in perpetuity. It's usually up to a certain amount raised, right, that they're protected.
Right, because at some point the cap table can't keep having that, and then you're
Of
going to
course.
hire other people. Here's some data on the chief medical officers, because we know this is of interest to everybody as well. And CMO can mean chief marketing officer, but in our world, it's chief medical officer. And you can see, because there are also founders here too, and you can see the dilution, much bigger dilution going down, right? Because we saw the CEOs and the founder CEOs higher. And then, but it's a big difference compared to someone who's hired from outside. Wouldn't you say here's median and then here's 75th percentile? And you can see the 75th and the median is still around 1%. I mean, some of these jobs are not rocket science. And I think companies have to remember, like what you were saying, Joanna, that the market data tells you, the speed limit, the 25th, 50th,
Exactly.
75th percentile. There's a lot of stability. But if you are hiring that Ferrari person, the data can tell you one thing, but you don't care because they may have come from pharma and their compensation is high on the cash side, but they still need to be parallel with their other peers on the equity side. So you're going to pay them because you have to. Or at some point, does somebody ever walk away and you're like, we're not going to get you where you want to be? And the fact that you don't understand the equity component, this isn't the right company for you.
Yes, it's
Yeah.
happened.
Yeah,
It's unfortunate.
We want to
I
hear
hate
everybody.
But I would say that, seasoned CEOs, seasoned CMOs, seasoned C-suite people are going to require a certain amount of money and a certain amount of cash compensation as well as equity. They're savvy enough to realize that.
I would just add there is a natural governor on this, and that is that if I'm doing a seed, let's say I'm creating a company, and a founder scientist has come to us, and we're going to put $3 million in. We realize that we're not going to recruit the executive with 30 years experience to work on a preclinical asset that's still a year and a half away from being in the clinic if we've only raised 3 million. Now, if you're in some VCs, they might put 300 million into a Series A. That's different.
Right.
They're going to be able to hire that.
It can happen. And you got to be prepared for that as well. But let me ask you this. How often in your young companies are you seeing where you're not even paying people more than minimum wage? And then, but at a certain point, you're going to have to stop that because it's only perpetuating behavior that is going to cause craziness inside of this young company.
Yeah, I'd say we look at it a little bit differently. If you're a private company and you have a founder that has a lot of direct equity, they understand that we are trying to advance the program and we don't want to spend too much money on compensation with building a big team, right? We'd rather use consultants, advisors, fractional, and we want you to preserve your equity. And we're going to be in the same boat as you to try to avoid dilution, right? But you're exactly right, Jody. We're not lowballing them, but we're saying, hey, there's going to be a time when we raise that Series A or Series B, or we go public, that you're going to get the
You're gonna
compensation.
have to have a day of reckoning to get out
Yeah.
of that like romper room, and in diapers, and you have to be a big, you have to have stability and you got to grow up. And Joanne, I know you're dying to talk here, so tell
Yep, yep.
us.
No, I just think that it's all about setting those upfront expectations, right? When we get to this certain point, this is when that transition is going to happen. And by setting those expectations up front, then everybody's tracking along with you. That they're preparing for that change. And that's incredibly important for that successful change in compensation
Even if
and
you're not going to
maturation
put
of
it
the
into
company.
effect, you got to get that structure and the scaffolding around it. And I stand
Yeah.
by the fact pay plans and all of this are so important because you need to plan for the next component of it. We've had a lot of questions. So, for the sake of time, I want to jump into this as well around the outside board member compensation, or it could even be a scientific advisory board. And needless to say, this has been a priority for companies at all stages and all levels for decades. So, we have great data on this. So, there are different levers that you can use, and that we look at the combination: one-time equity, meaning you get equity once; annual equity, which means you can be getting annual equity grants, probably smaller; and then cash, and then annual cash. And we see a combination of these. So this is what levers do you use to compensate your non-investor board members? And it's a check all that apply. And then we look to see in relation. So one-time equity dominates at 46.6%. And then we see a lot of life science companies, people who come in as outside board members or advisors who want cash and equity combined. And Chris, what's your experience with this?
Yeah, it really does vary. I think when you're early stage, you're trying to preserve that cash. And so, time equity doesn't make sense when you look at the large number of early stage private biotechs. As you move toward a public company, and particularly a public company, you see more of a mix of cash and equity,
Yeah.
and then
Here's
annual
this to
grant.
help you with that. That's exactly right. So here are the here's data by financing. So this is once you get into the 90 million plus, and truthfully, the data doesn't change until you get into the billions. So because but the 90 million plus, 150 million plus, 500 million. All these numbers you can see are the same. So you start with the one-time equity, but then as the equity gets more valuable, it's what you're saying is that you start to move into a little bit of cash, and then you get a little bit of everything, but it's pretty small over here.
Yep.
This is in alignment with what we see. I would say that there's always different recipes for making up these compensations, and some things that we've been seeing in the early biotech side, and Chris, you've already touched on this, is that board members might play a more outsized role in some cases, and they are leaning into almost a consulting role in addition to holding down the governance and being a board member. In that case, those expectations need to be set up front, and then compensation might look a bit different. So again, it goes back to that mix of cash plus equity.
Right.
Yeah, it's a little bit of the blurry line of executive chair versus chair of the board.
Exactly.
And if you get an experienced executive, right, people believe that it's worth their weight in gold if you give them enough equity or you compensate them so that if they're affiliated with a certain company, that's going to give them a lot of credibility, raise the valuation, make it easier to raise money,
Yeah,
et
here's a
cetera.
bone for the audience because we've had so many questions. Now, everyone who is sitting is now like the lights have come on. We have a lot of questions, but this is executive chair compensation. And you can see the one-time equity is the biggie. And you would
Yeah.
sort of shake this down. So it's 0.6 to 1% to 2%. It could be 5% if somebody's a badass and they are requiring, but that's a lot of equity, would have to be a very early stage company. And then for a non-executive chair, I would say it's more a 1/4%, a 0.5% at the median, and then 1% at the 75th percentile. We've had a lot of questions going on is how are options typically structured? So I know we're sort of racing along here, but I'm going to move into this section on the types of equity grants because this is relevant for everybody. So this week, and Chris, maybe you want to talk about this because it comes up all the time, and I know it's not a one size fits all, but what are you deploying in general?
Yeah, well, early stage, it's almost always options, right? Because
Right.
the risk reward, right, is much better for the options. And look, I mean, I think the structure of them are almost universally 4-year vesting. It can be 3 years for boards sometimes if you don't have a one-time fully vested grant, and it's a 1-year cliff, right? So if they
Yeah, here
get
is to
hired and they
provide
leave,
vesting. Yes.
yeah.
Vesting
So
is typically time based.
Yep.
Mhm.
Yep.
How
And
long? 4 years.
that's
You seeing any
that's
changes to
standard.
this?
That yeah, there's exceptions to that, but you can see that's the standard, and then you'd have to have a good reason to deviate from that standard
Sure.
in our experience.
Yeah, we hear for some like hot jobs that they really want to have that people are asking for, shorter vesting. Or Joanne, are you seeing that, Ellen?
Yes, in generally it doesn't end up happening. I would say that people really hold to that 4 year with the 1 year cliff. Always making sure that if there's a change of control, there's a clause in there, and that would end up being a automatic trigger.
Yeah, we had a good question come in, which is, do you this in general about refresh? It comes up all the time, replenishing or refreshing equity for founders, for for top jobs, for outside board members, and how we look at it and see it here at Thelander is that, and this why it sort of brings full circle as we come to the end of this webinar, but the more you plan and the better you get it right in the beginning, then the refresh and the replenish is easy because you're not going to you can't give, if you get the number right in the beginning, then you will have to keep pace. And you can see the stability from our numbers, like a non-founder CEO, 5%, 5%, 5%, once they're at a stable phase. And so if they're going to dip below and get down to 3.5% or 4%, and they were at 5%, the refresh is reasonable. If
Mhm.
somebody was at 2%, now you've got a problem because you haven't done it right to begin with, and you've got a lot of equity and ground to cover. And that becomes a burden on the cap table and the option pool. And people like Chris are like, this is not a situation where there's stability and you're asking us to correct it, but it's going to be at our expense. So it's the same thing with an outside board member. If you get it right and you want that board member to stay on, then chances are you'll give them an additional equity grant. But Chris, maybe you can tell us from your perspective, what do you think about that?
Well, look, it is the carrot that we use, right? You want are the people have earned their right to stay, and are they contributing value for the upside? And so you're constantly looking at management. You're looking at board makeup. Many of us on the VC side, we want to sell off if the company's going to go public, right? And so there's a constant kind of renewal. And I think it's really, who do you need to incentivize, and how are you
Correct.
going to incentivize them to stay on and create more value for the company?
Yeah, because you're going to refresh really this. It says it pretty much every time. It's going to be more on this one tells you this. Hang on, let me pull this up. And then we have some other questions coming up. Let's see, to whom do you refresh everybody? And it's more how long, it's on an as needed basis after a financing. It's obviously when there's dilution and then when you need key people to stay. The other question that came in is what happens with fractional people? Because you both mentioned it, that you are hiring fractional people in the beginning. And then how are you compensating them?
I can speak for our model, which is we generally will make it just cash, and they usually charge a premium than they would get for a salary, right? And that's the trade-off, right? It's the cash versus, and many of these fractional, they're taking on, three or four, sometimes more companies, right, on the fractional basis. And what we do is we say, hey, look, when we raise this next round and when we're ready to hire full time, would you be interested? We'd love to bring you on, and then we would be able to grant you the equity grant that would be deserving of a chief medical officer, whatever that role is that they're serving in fractionally.
I would argue that it's really important to know, if you're going to be the fractional person, to know what the compensation would be if you were hired in advance and go backwards from there. Joanna, what are you seeing in Ellen?
Yeah, that's exactly what we're seeing as well. But I would also say this goes to the same thing we've said previously, is that there's not one way to do this. It's got to be a good combination between the consultant and the company and what they're trying to achieve. And Chris, it's really interesting. Do your consultants stay then within only your portfolio, or do they end up going to other portfolios or other VCs as well?
It's a great question. So, if we can, and there's a need, then we'll have them support more than one portfolio.
Sure.
However, we usually are looking for domain experts, right? Someone who's really good in cancer may not work in immunoinflammatory disease or CNS or cardiovascular. So we tend to want that specialty, and that specialty person, as long as there's not a direct conflict, might work on a different indication, a different company, right?
Yeah.
If they have that domain expertise. But, I mean, at the end of the day, we try to have clauses that say they need to give us a certain amount of notice so we can find a replacement if needed. Sometimes we're pressured to say we're going to lose this person. If we really want them full time, we better, put that compensation
Are
package
you
together.
seeing employment agreements in general? I mean, usually founders are sort of caught, chasing their tail because they don't have employment agreements because they're just glad to have the financing and they're really passionate about the science. And then invariably, Joanna and Ellen bring in a candidate who has more experience and requires an employment agreement. And then you just got to circle the wagons and go back to the other executives that are there and they put them in place as well. But Chris, what are you seeing?
Well, we usually post Series A is when we will start to put a employment agreement in place. We're all in the same boat before that, right? We just wanted to survive. We want to get to
Yeah.
that next financing. And so, that hard line employment, do they get severance and, terminated, without cause, and do they get vesting and all that? Like that usually comes post Series A. And usually, look, it is a trade-off between how valuable are they? Are we doing them a favor, keeping them in the role of
Well,
CEO?
you'll know by your answer. If a founder comes and says, I want these things, and you tell them no, there's your answer
Right,
about
right, because they
whether
could
you
be
really have
replaced.
the long game.
Yeah, yeah, yeah,
Yeah.
exactly.
Going back to the fractional work, I mean, it's interesting now because so many people have used fractional CEOs, CMOs, CSOs, um, COOs in the past. And some people, and that's really changing now because the markets are picking up, hiring is going up. And some people are incentivizing their consultants, fractional people with equity because they're afraid of losing them. They're
I
afraid
think
that
so
another
too.
company
It's
is going
sort
to
of a
take them.
perspective on, they take some perspective on what it would be, and then they break that down per hour. So, and how do you find and source fractional advisors with very specific, I'm sure that can be very challenging.
It's all about,
Yeah.
Chris, go
Yeah,
for it.
Chris, go
Well, no,
ahead.
I'm going to say recruiters. I mean, this is where it comes
Yeah.
in, where recruiters might be changing their model to account for finding because you guys have a great database. But if we're not ready to hire a full-time person, short of recruiters who specialize in these fractional, we rely on networking, right? Sometimes hire hourly, talent recruiters who can find folks who are available as freelance or part-time. And we're seeing recruiters try to adapt and adjust. I'll let Am and Joanna, describe that.
Yeah,
Yeah.
why don't you say describe this and then we're winding up. We're in the,
Yeah.
the last 5 minutes. So great to get your perspective on this and then just overall what you're excited about and seeing for the rest of the year.
So regarding the fractional piece, it comes down to really the power of your network and speaking to folks, not just going out there saying this is going to be a fractional role, but who is the best person for this role? And would they be open to entertaining a different framework for working with a company? And we just go from there. You got to have the discussion, see where it goes, because it might not be them. It might be somebody they trained who could do exactly what they did, who's a medical director. And that's actually what the company needs at this point. And so it's really just having those conversations and getting detail oriented and really understanding the companies you're working with.
I would also add that, for some of these fractional folks, they're people that have recently exited companies,
Yes, that's what
have
I was thinking.
exited
Yeah.
companies, and they're not ready to go back full time, or they really want both the company and the an individual want to try and buy. They're willing to say like, this looks like great science, and and I'd love to jump in, but I'm not quite sure I'm ready yet, and I want to get to know them a little.
Yeah. Chris, from your expertise, what's going on? What are you seeing for the rest of the year and on the horizon?
I mean, it's risk off right now. And so, people are willing to, I'm sorry, risk on, meaning that people are deploying capital. The IPO market's performing well, follow-ons are performing well, reverse mergers and pipes are performing well. We're seeing VC start to open up their checkbooks more, and we're seeing M&A as robust. So I think you're going to see rich balance sheets. You're going to see more hiring. You're going to be seeing people being willing to recruit because there's going to be scarcity value in talent. So people are not going to want to lose out to their competitors to get the right people. And so overall, I'd say, after a 4 to 5 year, tough
Drought.
time for the industry, we're finally seeing some positive momentum.
Yeah, I mean, we've had literally calls. I'll wind up to thank you to all of you for being on. I mean, we just had a call with a potential client yesterday who participates in our survey, buys data, and now is looking to do either a pipe or some kind of a SPAC, excuse me, and or go public. That's what they're planning. So we are seeing M&A transactions. And all I can tell you is it's really important. As you can see, it's never too early to plan for your infrastructure, to look at your compensation, to understand who you're going to pay and how you're going to pay them and what the levers are. Even though you may have a different inflection of that with cash and equity, at some point it's going to level out. And the sooner you get it right, the less problems you're going to have. And of course, I can't emphasize enough how important it is to have great data. And J.Thelander data is unique. We are not plugging into payroll. The survey data is very well cleaned and vetted because young companies have some title inflation, and we account for all of that. So you have quality with our information. And you have a great quality panel that you had here today. We appreciate everybody's time. Chris and Alan and Joanna, thank you. And we will send out a follow-up and a recording. And of course, if you have any specific questions, please feel free to reach out to us. So thank you.
Thank you, Jody.
Thank you, everyone. Take care.